Good morning, it's Jeffrey Christian. It's about 10:15 in New York on Friday, the 3rd of June. I wanted to talk primarily about inflation and some of the things that are happening with inflation, but obviously with the gold and silver markets behaving the way they have in the past week, I'll talk a little bit about that first. What we have been seeing, it's interesting. I was giving an interview earlier this week and somebody said, I guess it's all been about interest rates, or the Ukraine rather, in the first quarter of the year. And I pointed out, somebody said, well, gold and silver haven't done much this year. And I said, in the first quarter of this year, from December 31st through the end of March, silver was the top performing asset in a group of 11 asset classes that we monitor on a quarterly basis, with about a 7.6% increase in price over the first quarter. Gold was about 6.6. The next best asset was cash at 0.6. And the other asset classes, stocks and bonds and real estate, were between 0.6% gain and a negative 0.7 loss in that first quarter. Gold and silver did very well. And in that first quarter, what we saw is we started the quarter with gold and silver rising very healthfully based on inflation concerns. Then they realized, the market as a consensus realized, that you were looking at rising interest rates, and perhaps strongly rising interest rates, and a very more intense anti-inflationary stance by the Fed and other monetary authorities, and the prices kind of came off. And then Russia invaded Ukraine and the prices went back up. But you had a very strong quarter. But the point I wanted to get to is that you've had this push and pull between interest rates and inflation, not only on gold and silver, but across commodity markets, across financial assets, and across the economy. And that push and pull continues. And we actually have been seeing that over the last few weeks. In the middle of May, gold fell below $1,800 for briefly over the course of one day, and silver fell below $22 briefly too. But you had a period of time where the financial markets were focusing on interest rates, and the idea of greater and stronger and bigger increases in interest rates sooner than they had expected, and that was reflected in lower gold and silver prices. Then they flipped back and they said, no, inflation is much more of a problem. And over the course of this week, we've seen gold and silver prices rise sharply. Gold, a week ago, we issued a gold trade recommendation, and we said that we thought that the gold price could get to $1,880 by today. It got to 0.1%, within 0.1%. It touched $1,878.60 this morning before the employment figures came out. That was 0.1% off of our short-term target of 1880, and well within our 0.5% margin of error in these short-term trade recommendations. Silver got to within 1% of our target from last Friday. We had said we thought the price could get up to $22.75. At the time, the price was probably around $22.20. People thought that we were a little bit overly optimistic, and the price did get up to $22.52, which is, I guess, within 1% of our target. We're looking at gold right now and silver, and we will be issuing trade recommendations today, Friday, the 3rd of June. We'll be issuing updates. And we do think that there's some downward pressure on gold and silver, but we're not quite sure that it's very strong, and it's going to be offset by upward pressure. The downward pressure has to do with interest rates and the upcoming Fed FOMC meeting in 2 weeks, and the fact that you're seeing signs of a stronger economy than a lot of people thought. So, i.e. the employment figures today. And those things could weigh on gold and silver prices over the next week or two, but they'll be offset by inflation concerns. As I said, and as you can see here, next Friday, the 10th, the Bureau of Labor Statistics will issue the U.S. Consumer Price Index for May. And our expectation is that you may see a high price levels, but maybe not necessarily a higher increase. The big unknown is you haven't seen food prices continue to increase, and you're seeing oil prices continue to increase through May. And that could actually cause a stronger CPI figure than we're expecting. But you're into that point now where you're measuring year over year, May 2021, when prices were already high and rising, to May 2022. So you may see a lower percentage increase in the CPI figure when it comes out a week from today. And then the following Tuesday, you'll see the US PPI coming out. But what I wanted to talk about was, well, partly the interplay between inflation and interest rates, but also goes on them. Now, before I get into that, let's review. This is US CPI through April, and you can see we had a very strong pace of increases in the second quarter of last year, April, May, June. Then we had a weaker third quarter where inflation CPI figures came off year over year, and then they rose again in the fourth quarter and in the first quarter of this year. By April, you were already measuring April 2022 versus April 2021 when prices were high, and you can see that on the right-hand chart. And you'll see the same thing in May when we see the May data. And I used these two charts, these two slides a couple weeks ago. They're still relevant, and we'll update them when we get the new PPI and CPI. Producer prices, very similar situation. So that's where we're at. We're at a point where we've seen high inflation now for 12 months. We're still seeing high price levels. There's still a lot of pressures on inflation, but we're getting into that period where the year over year figures, percentage changes may not be there. Now, one of the things we've been spending a lot of time explaining to clients and all is the origins of inflation and the relationship between the Fed and interest rates on the one hand and inflation on the other. Inflation comes from two sets of factors: the real economy, supply and demand for goods and services. The real economy can have inflation and does have inflationary implications. And then monetary policy. Too much money sloshing around drives up the prices of goods and services. So monetary policy is one of the factors, but the real economy is the other. And if you break it down, you can see demand, supply, fiscal policy, and overseas development. Now, the Fed controls money supply and interest rates. And interest rates and money supply have their strongest effect on the demand side of the real economy, quelling demand by raising the cost of money and making money a little bit tighter. It has a much less powerful effect, interest rate changes, on the supply side of the economy. And a lot of the inflationary pressures have been coming from the supply side of the economy. And actually raising interest rates can cause inflation on the supply side of the economy because suppliers of goods and services facing higher interest rate charges will sometimes, if they can, and they can right now, increase their prices. So rising interest rates can actually have an inflationary impact on the supply side of the economy. And that's problematic because, as I just said, a lot of the inflationary pressures that are coming that we've seen over the last 12 months have been on the supply side of the economy and not the demand side. Other factors, fiscal policy, extremely stimulative, and the Fed has no influence over that. And overseas development. And those three factors, supply side constraints, fiscal policy being extremely stimulative, and international developments like the Russian invasion of Ukraine and saber rattling between the United States and China and discussions about the future of the EU and Europe and other factors, all are having an inflationary impact. So the Fed is sitting there saying, well, we can sort of influence, we don't control it, but we can sort of influence the demand side of the real economy. But most of the factors that determine inflation actually are beyond our influence, let alone control. It's something that's missed on a lot of gold bugs and gold promoters and the sideshow guys on the internet talking about stuff. Now, there's another slide I used a few weeks ago. We've used it for years. And, money supply money supply increases do not necessarily lead to inflation. And we've seen that 9 times over the past 40 years, really since Paul Volcker changed the way central banks work. And everything prior to Paul Volcker, especially in that nasty period from 1971 to 1979, when you had a less than competent, in my mind, Federal Reserve Board composition. We had a very good one from 1951 to 71, and then with William McChesney Martin. And then we had a interregnum of about 8 years with just really bad people running the Fed, or not bad people, but just not people who knew what they were doing. And then Volcker took over in late 79, said we have to stop targeting interest rates and start targeting inflation, which is now at 14%. And the way we're going to target inflation is we're taking interest rates from 1 or 2% to 21%. Threw us into what was then the biggest recession in the post-war period, but he killed inflation. And that policy program that he used, both in terms of killing inflation with high interest rates, and then throwing money at the economy when it was in a recession, and we were on the precipice of an international debt crisis, and then sucking that money out by selling bonds and sucking up the excess liquidity in the currency market once we were out of that recession and away from the international debt crisis. That policy program has been used repeatedly since 1980-83, and it has been used now. Now we're in new uncharted territories given the largesse of the last few years, and we're in new uncharted territories with the fiscal policy, which is really the scary part to watch for. And the Fed has been saying since Paul Volcker's days to the Congress and to the administration, you've got to fix your fiscal policy. The Fed can stanch the bleeding in the economy, but real growth and real solutions to the long-term economic factors are fiscal policy issues, not monetary policy issues, with all due respect to Milton Friedman. And so monetary policy can only do so much, and it doesn't necessarily lead to high inflation. We are seeing this bout of high inflation, and you can see, really since Paul Volcker's policies of ratcheting interest rates up to 21% in late 79, early 1980, we have had inflation really below 5%. And, for a while it was between, say, 2% and 5%, and then it got really low, and it was basically below 3% for about a decade after the great global financial crisis and Great Recession. And now we're into this period, 12, 13 months into this period of higher inflation. And we'll see where it goes over the next 6 months and beyond that. And I won't bore you with questions about what is temporary inflation or transitory inflation. I will say that a year ago, when we were saying that we agreed with the Fed that the inflation was transitory, we made it very clear in our videos that transitory to us meant that we would have high inflation into the second half of 2022. Now, there are any number of those really brain dead guys on the internet who have made fun of that, but they just don't know what they're talking about. And you really shouldn't listen to them. I mean, you'll learn more about the real economy from Trevor Noah or John Oliver than you will from those guys. The guys who are saying, hey, gold's going to $10,000 any day for the last 50 years. Few housekeeping notes. Tuesday's video elicited this comment from E-Wolf said, F all the BS that you see on the internet. I value this type of analysis. E, I hear you, and I'm always trying to remember this and focus on what matters and ignore all of the trolls. It's hard to ignore the trolls. It's hard to ignore the threats, but I do try to focus on real issues because that is really where we like to live, and that's really what's important. Another slide I used a few weeks ago where I said, you know, people say, well, why don't you debate some of these brain dead folks? And I said, we don't, because they're not honest in some cases, and they're not intelligent. They don't know how to think critically, or they're not informed. They're not knowledgeable. Yeah, and then they're not ethical. They're not transparent. Hey, where's your money coming from? Oh, it's coming from a guy who has a history of spewing misinformation and trying to suck investors into really bad investments in gold and silver and in mining equities, you know. So we don't want to talk to those guys. We do want to talk to people who are intelligent, who are able to think critically, who are informed, knowledgeable sometimes, and who are honest and transparent. In line, I said, you know, we've made a few exceptions in the past. I spent 3.5 hours a couple weeks ago speaking with Jim Lewis of Wall Street Silver. And we started the conversation. He had reached out to me, I guess, initially in September of last year and said, hey, I'd love to talk to you. And I said, well, why don't you publish some apologies for all the garbage that you guys have printed on your website about us, and then we can talk about talking. And he hasn't done that. But I said, let's have a private conversation about this. And, you know, Jim is intelligent. He's not stupid. And he's honest. He's not unethical from what I can see. He comes from a different part of the world than I do. He has different ideas. He doesn't necessarily seem to be particularly focused on the silver market. You know, when I worked on Wall Street, if you were an investor, an analyst in the equity market or any market, you got a job as an analyst at a bank or a brokerage house, you didn't publish anything for a year. Your first year as an analyst was spent studying that market that you were assigned to. And at the end of that first year, you would have an industry report that had been vetted internally by people saying, yeah, this looks good. And, you know, they tear it apart if possible so that any errors in your logic and thinking and information would be corrected before it went public. And then you'd have your initial recommendations of investments in that industry. So you had a year of review and study with knowledgeable people looking over your shoulder saying, hey, this is right, this is wrong. And you know, the internet has kind of destroyed that. Now anybody can throw anything out there. There's no peer review. There's no screening. There's no editor that says, well, that's not even English, much less logical English. And CPM Group adheres to the view of knowledge and accurate analysis. We're probably unique in the precious metals markets from that perspective. So I spoke with Jim for about 3.5 hours on a Saturday a couple weeks ago, and we have agreed, Jim and I, that we will have an initial recorded conversation, and if that works out, we'll have more conversations going forward. And an honest, respectful, professional, informed discussion about the silver market and what he sees in it and what I see in it and CPM Group sees in it. So our plan right now, because of our busy schedules, both his and mine and CPM's, our plan is now to record that video on June 20th, and then they'll edit it, we'll approve it, and they'll post it. So stay tuned. Could be an interesting one. as my one son said, hey, what could possibly go wrong with that? We've got that. As I said, we're pretty busy. Right now, we are planning to release our Platinum Group Metals Yearbook on June 28th at the end of the month. We may wind up rolling that into July because we're so busy with other stuff right now. Hard to say. Next week, we're going to have a silver online seminar, and we sent out a news blast about that yesterday. It's open to the public. It's online, and people can plug in and look into it, and there will be a mechanism for you to ask questions. It's, I think, 11 a.m. Eastern time on Thursday, the 9th of June. We're kind of thinking it's an hour, but it could be longer. We also will be doing work at the Prospectors and Developers. I'm giving a speech on gold and silver on Monday. I'm giving another speech on critical minerals and minerals critical to Canada on Tuesday. And then we have a range of meetings and interviews we're doing there too. We still need to reschedule our open forum for the second quarter for our paying clients. And we have a ton of other things, initiatives that we're working on. So stay tuned. Should be an interesting June and July. I don't think there's going to be any summer doldrums at CPM Group. You can go to our website, learn more about us, and then we're around. Thank you.